Winston,
What's up, Todd? How you doing, man?
I'm doing good, man. How are you? Happy New Year.
Happy New Year to you. Did y'all have a good one? Bring it in the right way, family?
We didn't even make it to midnight. Uh, two two kids, an infant and a 3-year-old, were dragging our arms to go to bed. Got to 11:15, so better than last year, but we didn't quite make it yet. Hopefully next year we'll make it to celebrate to midnight.
That's cool. Well, we turned it down a little bit this year, but we had a great New Year's Day, and it was fun. It was good. It was a good 2022, and I think we're gonna have a great 2023.
Yeah, I
So,
agree.
well, hey, look,
Awesome.
let's get started. We got a good one today with the infamous Hooters, right? I'll
Hooters. I
leave,
haven't.
I'll leave
Jesus.
my cheesy comments out of this underwriting session, but Hooters is notorious, and they actually just got news that they're shutting down. I believe so. I kind of heard that through like the Christmas break, so I haven't done a lot of research on this.
Hmm.
I'm not sure exactly what their plan is, but it's my understanding they're either going through a rebranding or going through like some sort of large change. So let's talk about it.
Yeah, man. Share my screen here real quick. So yeah, this Hooters, it's interesting, right? Like, I've been reading some stuff up on them as well. Just looking at this underwriting, they're doing some rebranding into Hooters Wings and like getting into some gambling, sports betting stuff. Just really trying to change their brand, right? I think today's day and age, it's tougher to sell the Hooters quality service than it was maybe like 30 years ago or whatever. But
Yeah,
this specific asset, um, I mean, it's still got 12 years on the lease. Even though I guess we're going to need to discount these cash flows pretty hard, given the chance, probably they won't stick around, or they may even shut down before those 12 years are up, right? So um, this Hooters in particular is in Valdosta, Georgia. So Valdosta, Georgia, for those that don't know, is pretty close to the border of Florida. It's down there, you know, pretty close to Tallahassee, um, Jacksonville, etc. Um, this Hooters is in a hotel zone, so it's a restaurant zone, hotel zone. I'll pop it up here on the Google Earth so we can see better kind of what the land here looks like. Because for this one specifically, we really do need to think about retenanting and potentially redeveloping. So this is actually a little over 4 acres of land, and it's a 4,200 square foot building. It's pretty much all hotels and restaurants around here. So you can see you have like an Outback Steakhouse, you have a Texas Roadhouse here, you have your Hooters here, and then you have all of these hotels around. So in the case that you were to need to re-tenant this thing, it's very likely it would be another restaurant. I mean, do you
right.
see any other use case here, Winston?
No, I mean, there's of course it could always be turned into something. I mean, another use case. Let me take that back. I said no. I don't mean that. I mean, I think looking where it is, you could put medical office there. That's kind of med retail type stuff, because it's not right on the main strip, but it's kind of back off. But it's got great visibility right off that interstate. I think the
Hmm.
highest and best use is probably what it is right now,
Yep.
unless you could get some sort of rezoning to go vertical for some mixed use or something. So, I think my answer is yes. I think right now the best use is restaurant, and so I would imagine if we re-tenant it, unless we're able to change the rezoning to allow for, uh, to increase on the vertical limits, I think we're looking at a restaurant here.
Yeah, I agree. Um, so let's pop this open a little bit. Look at some of these cash flows, some more details of what's being offered here, right? So this Hooters is being offered at nearly $3 million. It currently has a net operating income of $166,000 a year. There's 12 years left on a 20-year initial lease, and then after those 20 years, So so Hooters, if they stick around, they've got this thing for the next 32 years. But if they don't, then it's another story. This is an absolute triple net lease, so different than the last couple of ones we've underwritten, which were double net plus. They are responsible for the structure and roof of this building. And it's a corporate guarantee. Yeah.
Who is responsible for the structure and roof?
Hooters, the corporate guarantee. Yeah. Yeah, they're responsible for everything. Everything. Utilities, property insurance, property tax insurance, structure, roof, everything. It's absolute. This one is absolute triple net lease. And they're asking. So the asking price on this is a 5.65 cap. Initially, I thought that was a bit low. I did some research. There have been 2 Hooters that have sold in the last 6 months, and they sold at around, one was 5.6 something, one was 5.7 something. So, as far as the market's been saying, 5.65 doesn't seem unreasonable. Although in my analysis, I find it to be a bit expensive. The market apparently thinks it's not that expensive. So the first thing we're going to do is, look at this, the simple cash flows, right? We'll start with, if we were to buy this thing at the price they're asking, at a 5.65 cap, we have some closing fees. We're going to be out of pocket nearly $3 million. The operating cash flows in this are pretty straightforward. They're not as great as a lot of other of these net lease asset contracts. They have 8.5% bumps every 5 years. The next bump coming 3 years from now, then 8, 13, etc. every 5 years. So, different than the lease that you might buy with a 2% bump every year. If you hold this thing for a long time, you're gonna have significantly less cash flow appreciation than you would on some of these other net lease assets. So that's something to just keep in mind. That really depends on how long you expect to hold this asset, right? So, and so as you can see here, I have no reserve put away. The net lease is actually the net money that you make because they're in charge of roof and structure. So there's no reserve here.
Yeah. So something to add there, like Tyler, and we get this. I get this a lot. Is a lot of times banks will still ask that you put something away, right? They'll say, well, yeah, but you always have to have something, right? So remember, banks are always going to be a little bit more conservative. They're always going to ask you to put, just be a little tad bit more conservative. So I have a client now where we go back and forth, and they're like, well, it's not absolute triple net because, of whatever reason, like the bank's making me. I'm like, well, that's your relationship with the bank, but there's, maybe you should budget to put some capital back for the what ifs, but contractually, this is an absolute triple net lease. There's zero landlord responsibility. The landlord doesn't do landscaping. They don't fix the roof if it breaks. There's nothing. They don't resurface the parking lot. None of that. And so, how conservative you want to be with your underwriting is up to you. But good point, Tyler. I just want to point that out.
No, great job. Great point. So this one, for the disposition cash flows, obviously next acquisition, operating, disposition cash flows. We're doing a bit of a scenario analysis here. So I'm going to open up these first 2 scenarios, where they re-tenant and the other one where we have to do adaptive reuse. By the time we get to the end of the contract in year 12, the rent's actually going to be pretty decent. It's going to be $213,000 a year. If they were to re-sign and we were to sell this thing at a 6.25 exit cap, which would be a decrease of 5 basis points a year on or an increase of 5 basis points every year on the cap rate, so a decrease in price, just because it's going to be an older building, older contract. We'd be getting out net proceeds at about $3.2 million, right? So we'd be getting out at profit even if we're selling at a worse cap rate, simply because of the rent increases. Scenario 2, the adaptive reuse. I'm assuming we'd spend $50 a square foot. Really hard to estimate that at this point, exactly how much. I'm assuming we'd just be finding another restaurant tenant and not doing a complete overhaul of the building. And I'm also assuming that the rent that restaurant would pay would be somewhat in line with the rent that we're getting from Hooters. So in that case, if we did an adaptive reuse with those numbers and we had an exit cap rate slightly better than the Hooters exit cap rate, because remember, we've just got a new tenant, new contract on a building that's just had some renovations, we should actually get out of there at about the same price that we get out of it if we just sell an ongoing Hooters contract.
Mm-hmm.
So I've assigned 80% chance they renew, 20% that we do an adaptive reuse. Maybe that's even high for Hooters. I don't know. Could even be 20-80. Who knows? If the Hooter Wings gambling thing doesn't work.
Well, I did a quick little look, and there were some articles that was saying that was actually like false reporting, and that Hooters has kind of reviewed it and said, no, Hooters is here to stay. Their restaurant concept isn't going anywhere. But so no one knows. I mean, I don't know if it's just like some rumor that went viral, but all things considered, there's a reason why people are talking about that. And so I would say it's a higher risk than normal. So I think 20% is probably pretty good. It may be a little high, but I think 20% is pretty good.
Well, I mean, and the other thing is here with this situation, right, where we have these scenarios, if we believe that the reuse scenario is going to be pretty in line with the re-signing and selling scenario as far as net proceeds are concerned, then it doesn't really matter what those probabilities are. They're because the net proceeds are pretty much the same. So if it was 50-50, if it was 10-90, it's not going to make that much of a difference at the end of the day, assuming we could re-tenant to another restaurant without massive re-tenanting costs.
Yep.
Okay, so let me just close these now, and we will pop open. So this here, just real quick, this is the weighted average of those two scenarios, 90%, 10%. So our weighted average net sales reversion is 3.2 million. So I'm going to open up the IRR now, so we can look at how this looks with a loan. So these are your cash flows. This is new this week. We can play here. So if you use 70% leverage at 6.5% loan rate, these are the cash flows that you come out with, right? So you're going to get 6.6% unlevered, which is almost exactly what you're paying for your loan. So your leveraged or unleveraged returns are going to be basically the same. Like I can play with this if I don't have a loan, if I'm completely unleveraged, right? You can see that my unlevered and levered IRR are 6.61 there. If I get up to 90% leveraged, go negative cash flow, but at the end of the day, I'm 6.77 because I'm making it on the back end, right?
Yeah.
So how much leverage you want to use on a deal like this is going to make zero difference almost to your to how much you make at the very end of the deal. The only thing it's going to impact is your cash flows during the deal. So as you can see, you have negative cash flows during the deal if you do 90% leverage, but somewhere around 70% leverage in a deal like this, you're going to be pretty much cash flow even. You can see you were negative for the first 2 years, and then you got positive at that next bump. So everyone's situation is different depending on how much money you have to put down or whatever. Just know in this situation where the unlevered IRR is very similar to the loan rate, the amount of loan you take is only going to impact your positive or negative cash flows year over year, and not really going to impact your total project returns. And in a situation like this, 6.5% return on a perhaps dying restaurant, I don't think it's that great. So,
we'll just put out the message here is we have no idea what Hooters is going to do. We're just kind of talking about what some of the rumors are, but it's a disclosure, if you will. But yeah, I mean, look, there is a reason though. I've talked to investors who they don't necessarily mind the negative cash flow because they use it as a tax advantage, right? So even though I personally would never buy anything that isn't cash flowing, right? And I think the vast majority of investors that I work with would not buy something that was not cash flowing. There are some that are like, look, what I want is a great piece of property, right? I want a great piece of property, and I would, and then after I get the great piece of property, I want a great tenant, right? And that's kind of how they rank it. They don't necessarily care so much about the cash flow because they're long-term holders and they need the tax advantages that real estate offers them. So,
Yeah, I mean, at the end of the day, everyone's situation is different, right? Like your liquidity needs are not my liquidity needs. Maybe they already have cash flow from a different investment, and they're willing to take, negative cash flows on this so they can get, other advantages. Not every one of our investments needs the cash flow at the end of the day, right? We need enough cash to live. The rest should just be looking to maximize wealth over your lifetime.
yeah.
So the last thing I wanted to look at here, we looked at the IRR analysis using their suggested purchase price. I'm going to suggest a different purchase price that puts the cash flows kind of where I think they belong. So if you were to get a corporate bond, invest in corporate debt today, your double B and B rated bonds are in the 7 to 9% yield to maturity range. I think this is the first time I've done this where I think the income cash flows should demand a higher discount than the disposition cash flows. So I would actually want to demand 9% on my income cash flows, which would be in line with a B corporate bond, which I don't think is that unreasonable given all the rumors around. And then I would ask for 8% on the disposition cash flows to discount those because I actually think the retenanting would be relatively easy. And if I were to discount my cash flows at those rates, I'd actually be offering a 6.5 cap or 2.5 million rather than nearly 3 million they're asking. And if you look down here, this is just a simple histogram of restaurants that have closed in the last 2 months. You do have the bulk of restaurants closing here in this 5 to 6% cap range. But, a lot of those are, newer leases, newer buildings, better tenants. These are Burger Kings. These are Starbucks. We did have those 2 Hooters in the mid to high 5s, but I don't think you'd be unreasonable asking to purchase this Hooters in the low to mid 6 range, even though it's a little bit of a higher cap rate than most of the other restaurant franchises. I think you could make a case that Hooters is not, in the top 50 to 75% of restaurant tenants, and therefore demand to be in the 25% of the higher cap rates.
Yeah, I think that's a fair one. And you said this was a corporate back guarantee. Is that correct?
Yep. Corporate.
Okay, good. Well, that matters, right? That's different. You kind of want corporate back guarantees over just kind of like franchisee guarantees typically, right? So that is advantageous. I can't find Moody's or an S&P credit rating. Have you been able to find one of those for Hooters?
No, they're private.
Yeah.
So you can't. They won't. You just have to. They won't give you a credit rating on these private companies. So you have to just kind of. You've got to eyeball it. You got to eyeball it versus a public company with a credit rating that you think would make sense.
You didn't get my joke. You didn't get
I didn't get it.
Hooters joke.
Sorry, man.
I said wing it. You get it, Hooters, wing it. Anyway, I'm teasing. Yeah, well, that obviously matters.
I'll blame it on my internet delay.
Yeah, that obviously matters. It being private, so I would definitely want to see their financials. I would look at the lease, see if they have any sort of clause in the lease where they need to share their financials, especially at a time right now where you have some rumors swirling. And just kind of request to see some financials too.
Yeah.
And store specific financials as well. Look, I mean, sellers and tenants, they typically don't want to share that information. They do have competitors, they have other people they're not going to share you any information that you ask, but you can ask for anything. So in this situation, I would definitely ask for some financials.
So you gonna buy this Hooters, Winston? Is this gonna be the new? This is gonna be the new Winston Warren headquarters where we hold client meetings?
Probably not, but I think it's an interesting buy because you can probably get this. Look, it's 4+ acres sitting on a lake, in a good area in Valdosta, Georgia, right? You've got, if it does for whatever reason go under, if the rumors are true, you can definitely re-tenant this because, like I said, I think the Valdosta Mall is like across the street. And again, it's sitting on a lake, so it's got good views and kind of that vibe. I don't know what the zoning is. Can you subdivide it up a little bit? Could you get another potential parcel out of this property with the 4+ acres? I don't know. I don't know how much of it's buildable, right? I think it's a good piece of property. Now, I think the cap rate they're asking is about 4 to 5 months old. Personally, that's what I think. I think the cap rate that we're suggesting is a fair and an honest cap rate. That's what I think. So I wouldn't give it. What is it listed as, a 5.75, Tyler?
What would we
What
offer?
is it listed at?
6.5. It's listed at 5.65.
Okay, yeah. I think 6.5 or better is what this is actually worth, unless it actually has another buildable lot on it. At which point, I think paying a 5.65 to 6 is reasonable. But if it's not, I would definitely, I wouldn't do anything lower than a 6.5 cap.
Yeah.
But I like it. I mean, look, Hooters isn't my thing. I wouldn't buy it for the restaurant. For some people, it's off-putting. Other people, they love the brand. They're very loyal to it. But everyone loves chicken wings. And at the end of the day, if their model is selling wings and beer and sports. And so Georgia's a big sports state, and they've got a lot of professional teams. And we want great locations with great tenants and good leases. So I would say this is a very good location. I would say this is an all right tenant. It's hard to tell because they're private. You don't know their financials. So I think this should be considered, but only at a 6.5 or above.
100%.
You agree? We agree on this?
I'm with you. 6.5 cap. We're buying a Hooters in Valdosta, Georgia.
We could go there for meetings, so we're not going to shut down yet. We could go there for meetings, but all right. Well, this was awesome. Thanks, Tyler. Another successful one in the books. If anyone's interested in this one or wants to chat more or do kind of a deeper dive in Valdosta as a market, or as Hooters as a whole, let us know. Contact one of us, and we'll be happy to look into it.
All right, that's it.
All right, Tyler.
See you later.
Bye.
Cheers.
Cheers.